Goldman Sachs just dropped a 103-page report on what they think happens to your portfolio in 2026. Their equity research desk is predicting 7% returns. Their clients are quietly asking if it's time to bail on US stocks. And the cyclically adjusted price-to-earnings ratio, the one that Robert Shiller won a Nobel for, is sitting at levels only seen twice in modern history. Once right before the dot-com implosion, once right before 2020. So here's the uncomfortable question nobody wants to ask out loud. Are we about to watch the third act of that movie? Or is this just another round of smart people being paid to worry professionally? I spent 10 years running a business where every quarter I had to sit across from accountants and tax lawyers who explained in painful detail how incentives actually work. And one thing became crystal clear. When Goldman Sachs publishes a 100-page outlook, they're not doing it because they love you. They're doing it because their clients, the ones managing billions, are nervous. And nervous clients ask questions. And when you're charging 2 and 20 on assets under management, you better have answers that sound smart enough to justify the invoice. So I'm going to walk you through what this report actually says, what it's trying not to say, and why the psychology behind it matters more than the charts. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard return assumptions to expose the weak points in your plan. And I only ask for your email so I can send you the report without storing your financial data. Link is in the description. Here's a central metaphor I want you to hold in your head. The stock market in early 2026 is like a poker game where everyone at the table knows the deck is slightly rigged, but nobody wants to be the first person to fold because the pot is enormous. Goldman is basically the guy who just checked his cards, looked around the table, and said, I'm staying in, but let me tell you exactly how many outs I think we have. That's what this report is. It's not a prediction, it's risk management theater. Let's start with what they're actually saying. US equity markets returned 99% since their 2021 outlook. That's essentially a double in 5 years. Non-US developed markets did 60%. Emerging markets did 24%. China is down 14%. And here's the thing that should make you pause. When you have that much divergence, someone's math is about to get corrected. Either the US is genuinely worth twice what it was 5 years ago because of productivity and earnings growth, or we're in a valuation bubble that's being held up by momentum and the fact that there's nowhere else to park money. Goldman's argument is essentially this. Yes, stocks are expensive. The Shiller PE ratio is hovering near 35, which is higher than any point in history except late 1999 and briefly in 2020. But here's their out. They say the Magnificent Seven, your Googles and Apples and Nvidias, are trading at forward PE ratios around 29. During the dot-com bubble, comparable companies were over 50. So by that logic, we're expensive, but not insane. That's the argument. And on the surface, it holds. But this is where systems thinking comes in. Because the question isn't whether NVIDIA is expensive relative to 1999 Cisco. The question is whether the assumptions baked into those earnings forecasts are realistic. And here's what nobody wants to say out loud. Those earnings forecasts assume AI infrastructure spend continues at the current pace for the next 3 years. They assume no recession. They assume China doesn't escalate rare earth export restrictions. They assume the federal debt to GDP ratio, which is already pushing 120%, doesn't spook bond markets into demanding higher yields. Now, you're asking yourself, okay, so what's the actual crash risk? Goldman puts recession probability at 25%, not 0, not 50, 25, which in finance speak means we think the base case holds, but we're hedging. And the way they hedge is fascinating. They break down expected returns into 3 buckets. Earnings growth plus dividends gets you 11%. Then they subtract 4% for what they call multiple compression. That's a polite way of saying, we think PE ratios are coming down because people are going to get nervous and pay less per dollar of earnings. So 11 minus 4 gives you 7. That's their headline number. 7% nominal return for the S&P 500 in 2026. But here's where it gets really interesting. That 7% assumes the poker game continues. It assumes everyone stays at the table. The moment someone big folds, the moment a sovereign wealth fund or a pension system decides US equities are overweight and rotates into something else, that 4% compression estimate starts looking optimistic. Because markets don't reprice in a vacuum. They reprice in cascades. And Goldman knows this, which is why buried in the report, they have a whole section on what they call localized vulnerabilities. Credit spreads in commercial real estate, consumer debt-to-income ratios, the fact that China controls 92% of rare earth refining and 94% of global magnet production. These aren't footnotes. These are the outs in the poker hand. Let me give you a concrete example with real numbers. Let's say you're a 52-year-old with $850,000 in your 401k. You're planning to retire at 62. You've been getting 10% annualized returns for the last 5 years, so you're feeling good. Your plan assumes 7% going forward because that's what Goldman says. At 7%, your 850 grows to about 1.6 million by 62. You can pull 4% a year. That's 64,000. Plus Social Security gets you maybe another 30,000. So you're at 94,000 gross. Comfortable. But here's the problem. If Goldman is wrong by just 3 percentage points, if the actual return is 4% instead of 7 because of a recession or multiple compression or whatever, your 850 only grows to 1.1 million. 4% of that is 44,000. Plus Social Security is 74. You just lost $20,000 a year in retirement income because a research report was slightly optimistic. And this is why the psychology matters more than the math. Because the math is always a story someone is telling you about the future. And the future doesn't care about models. Now, you might be thinking, okay, so what's the alternative? Do I sell everything and hide in cash? And this is where Goldman actually gets something right, even if their incentives are conflicted. They show a chart that tracks what happens if you miss the 10 best days in the market since March 2009. Your annualized return drops from 17% to 12%. Miss the 25 best days, and you're down to 8%. And here's the brutal part. Most of those best days happen during periods of extreme volatility. They happen right after crashes. So if you panic and go to cash during a downturn, you miss the snapback. And the snapback is where all the return lives. This is the prisoner's dilemma of investing. Staying in feels stupid when things are expensive. Getting out feels smart until you miss the move. The report also talks about risks nobody wants to price in. US debt to GDP is on track to hit 140% by 2034 if nothing changes. They lay out policy options. Let the Trump tax cuts expire. That shaves 10% off the debt ratio over 10 years, but also creates a drag on GDP. Wealth tax on ultramillionaires, that's another 7%, but good luck getting that through Congress. Social Security Trust Fund runs dry by 2033, at which point benefits get cut to 80% of current levels unless they raise the payroll tax cap or push retirement age to 70. These aren't conspiracies. These are actuarial math problems with political solutions that nobody wants to implement because they all involve pain. Here's the comedic reality. Goldman's clients, the people who actually move markets, already know all of this. The report isn't for them. The report is so that when things go sideways, Goldman can point to page 73 and say, we flagged that risk. It's preemptive blame management. And the funniest part, it works. Because institutional investors don't get fired for following Goldman's advice, even when it's wrong. They get fired for ignoring it and being wrong. It's classic incentive misalignment. The advisory business isn't about being right. It's about being defensively wrong. Here's another angle. Gold is up 137% over 3 years, 65% in 2025 alone. Meanwhile, the S&P did 18% last year. That's solid, but it's not 65. When gold outperforms equities by that margin, it's usually signaling that someone, somewhere, thinks the monetary system is sketchy. Central banks have been buying gold at record pace, not because they think it's going to the moon, but because it's the one asset that doesn't have counterparty risk. It's nobody else's liability. And when you're a central bank watching the US debt to GDP ratio climb and the political system become increasingly dysfunctional, gold starts looking like insurance. The fact that Goldman even included a section on gold tells you something. 5 years ago, they would have dismissed it as boomer nostalgia. Let me tell you a quick story. In 2007, I knew a guy who worked at a regional bank doing commercial real estate lending. Smart guy. He saw the housing market getting frothy. He saw loan-to-value ratios creeping up. He saw stated income loans being handed out like candy. And he raised concerns internally. You know what happened? Nothing. Because everyone above him was being paid on volume. Their incentive was to keep the music playing. And when the music stopped in 2008, that bank got absorbed by a bigger bank, the executives got severance packages, and my guy got a job at a credit union. The system didn't punish the people who caused the problem. It punished the people who didn't have optionality. That's how financial crises work. They're not moral events. They're repricing events. And the people with the most information and the most resources are usually the ones who get out first. So where does that leave you? Here's the thing. Goldman's 7% forecast might be right, it might be wrong. But the framework they're using, the one where you can cleanly separate earnings growth from multiple compression and add them up like Lego blocks, that framework assumes markets are efficient and rational. And markets are neither. Markets are made up of humans with mortgages and bonuses and fear and greed. And when everyone is sitting at the poker table with expensive hands, the person who wins isn't the one with the best cards. It's the one who can stay solvent long enough for everyone else to fold. Here's what I'd actually do with this information. 3 things. First, if you're over 50 and you've had a great run in the last 5 years, take some chips off the table. Not all of them, but if your allocation is 80-20 stocks to bonds, because that's what it was when you were 40, maybe that's 70-30 now. Not because I think the market's crashing tomorrow, but because you have less time to recover if it does. And the math of sequence of returns risk is brutal. If you retire into a downturn, your portfolio can get permanently impaired, even if the market recovers later. Second, stress test your plan against a 4% return instead of 7%. Run the numbers. If your retirement still works at 4%, you're fine. If it doesn't, you have a problem that more risk won't solve. You need to either save more, work longer, or spend less. Those are the only levers. And third, recognize that nobody, not Goldman, not me, not anyone, knows what happens next. The best you can do is build a plan that works across multiple scenarios. You want optionality. You want liquidity. You want to not be the person who has to sell at the bottom because they over-allocated to risk assets and didn't keep enough dry powder. Here's the part that nobody wants to hear. If Goldman is wrong, and we do get a real correction, the people who will do fine are the ones who are boring, the ones who rebalanced annually, the ones who kept their allocation consistent, the ones who didn't check their portfolio every day in panic. Lazy investing built more fortune than crypto memes. Because the people chasing 10x returns are the same ones who sell at the bottom when their Coinbase account is down 60% and they can't sleep at night. The person who owns a boring index fund and keeps contributing through the downturn is the one who retires on time. Goldman's report is 103 pages because nuance is expensive. And clients pay for nuance, but the actual takeaway is pretty simple. Markets are expensive, risk is elevated. Returns are probably going to be mid-single digits for a while, not the double digits we got used to. And if you built your retirement plan assuming the last 5 years are the new normal, you're setting yourself up for disappointment. That's it. That's the whole report. Everything else is just charts and footnotes, so they can say, they warned you. The crash everyone is worried about might happen. It might not. But if you're asking whether it's time to panic, you're asking the wrong question. The right question is whether your plan is robust enough to survive being wrong about the timing. Because timing is the thing you can't control. And trying to time the market based on a Goldman Sachs report is like trying to win at poker by reading the other guy's tells while ignoring your own hand. It's backwards. So no, I don't think Goldman is predicting a crash. I think they're predicting a grind. Lower returns, higher volatility, more political risk, more uncertainty. And their clients will pay them handsomely to manage that uncertainty, even though the optimal strategy is almost certainly to do nothing and stay diversified. But doing nothing doesn't justify a 2% management fee. So instead, we get a 100-page report that says, in very sophisticated language, nobody knows, but here's our best guess. And also, please don't fire us if we're wrong. The poker game continues. The deck is still rigged. And the only question that matters is whether you can afford to stay at the table long enough to see how the hand plays out.